So these stocks are at their 52-week low, so I'll be covering them today. And besides that, we'll be talking about market valuations. So the stock market is officially at all-time highs again. We closed at around 6,300 points and the markets are now euphoric. So the fear and greed index is currently now in extreme greed. We're currently 75 out of 100. And it's quite amazing how just 3 months ago, we were at around extreme fear at around 3 points. Currently, we're at 75 points. So you're seeing a surge in all your meme coins again. So OpenDoor, for example, is up around 100% today. And over the past 1 month, the stock is up around 7x or so. You're seeing valuations that are overstretched as well. So the S&P 500 is currently trading at a 24 times next 12-month earnings. And the equal weight is trading at a 17 times forward earnings. Your Nasdaq is trading at around 29 times forward earnings. So the markets in general are just overvalued at this point. And it's hard to find stocks that are undervalued today. And besides that, we're seeing the bill coming in, basically increasing spending in the US, which will probably push up asset prices and lead to an even more overvalued market. So with stocks being overvalued and reaching 52-week highs, these are the stocks that are at its 52-week low. So the first stock that I'll be covering is Elevance Health. Elevance Health is down 24% year to date. It is currently trading at around 10 times next 12-month earnings. So based on their EPS guidance of around $30 EPS per share, the company is currently trading at around 10 times earnings, which is quite cheap relative to its history. So for Elevance Health, their CEO is buying the stock. So Gail, which is an incredible CEO, has been buying the stock recently. She just bought the stock last week on 18 July and she filed in around $2.5 million worth of share buys in just one single block. So for our insiders, they sell for many reasons, but they only buy for one reason, because they think the stock is undervalued. And Gail likely thinks so as well, and that's why she's buying the stock. So the healthcare sector has been massively underperforming the S&P 500 over the past 12 months. So this is the healthcare sector and S&P 500 total return ratio, and currently we're sitting at a record low. So the last time it was this low was in 2001, and shortly after we reached this point, your healthcare stocks actually massively outperformed the S&P 500. They went up by quite a fair bit, and currently now we're sitting at a similar point as well. So your healthcare insurance companies are priced as though they're running out of their business, and a lot of them are down massively year to date. I mean, United Health is down around 50% year to date. You have companies like Canteen, Elevance, Humana all down 40% in just the past year alone. But the truth is, the people in the US will still likely need the healthcare insurance, and the healthcare insurance company can simply just jack up their prices next year to increase their margins needed to sustain the business. So this could be a similar episode as what we've seen in the past, where Wall Street panics over a certain sector, and then that certain sector outperforms over the next few months. The next stock that I'll be talking about is an undercovered one. It is this company called Brown & Brown. Brown & Brown is up 3% year to date. It is now around 20% from its highs. So this stock is an insurance broker. What they do is they help sell the insurance and then they collect a commission. Insurance is a necessity and your consumers won't stop buying it because they have to. This will give Brown & Brown a stable stream of revenue every single year. So for Brown & Brown, it is falling because your healthcare insurance stocks are falling as well. But for Brown & Brown, what they sell is they sell privatized insurance. So those are unaffected by your Medicaid and your Medicare cards. And this could be a decent opportunity for you to look into this one. So the fundamentals for this company are quite solid as well. Revenue growth has been around 12% to 15% over the past few years. EPS growth has been between 10 and 20% over the past 5 years as well. So this is clearly a quality company with decent fundamentals that is trading down because of a perceived sector headwind. So the next company that I'll be talking about is Salesforce. Salesforce this year is down around 20%. It is currently trading at a 41 times earnings, giving out a 0.63% dividend yield. So for Salesforce, this company is the largest CRM provider, your customer relationship management provider. So CRM holds around 21% market share, and the next closest competitor is actually Microsoft with around 5.9% market share. So Salesforce clearly has a dominant market share in this segment. And for Salesforce, the concerns with the business is simply just the revenues decelerating. So over the past few years, we've seen deceleration in terms of Salesforce growth. So Salesforce went from around a 20% revenue growth to currently now at around 8%. The management is guiding for around 7% revenue growth this year. So 7% revenue growth is not amazing growth by any means. There's decent growth for a company, but not for a company that is trading at 41 times earnings. So for Salesforce, the current price to real free cash flow is at around 25 times. The PE ratio is at around 40 times. So the disparity is due to high depreciation and amortization. A large chunk of Salesforce free cash flow is made up by depreciation as well as amortization. So the D&A actually makes up around 33% of their total free cash flow. their real free cash flow. So the company at a price to free cash flow of around 25 times is not demanding today. I think it's a decent valuation for a software company, a recurring revenue software company. So for Salesforce, this is what I dislike with the company. The company does a lot of acquisitions. So when it comes to capital allocation, your management can choose to do a lot of different things. They can choose to do buybacks, they can choose to give out dividends, or they can choose to do mergers and acquisitions. So when it comes to companies, you want companies with organic revenue growth. You don't want them to continually chase for mergers and acquisitions because that is considered low quality revenue growth. And when a company is solely reliant on mergers and acquisitions, it is unpredictable, and a lot of the deals over here actually fail. So for example, Salesforce, they bought Slack at $27 billion, and an acquisition wasn't a very good buy. In fact, Slack is still lagging behind Microsoft Teams, and the integration wasn't as perfect as what Mark Benioff said it would be. So this is what I dislike about Salesforce. The only problem that I see for the company is basically just their reliance on acquisitions. Their CEO loves acquisition, and that is the problem with the business itself. Other than that, I think the valuation today at a price to free cash flow of around 25 times is reasonable for this company, although it is not massively cheap by any means. The next company that I'll be talking about is Deckers. So Deckers is down around 50% year to date. It is currently trading at a 16 times earnings. So for Deckers, the revenue growth has been quite impressive. They've seen revenue growth of upwards of 15%. In fact, in recent years, it's been around 20% or so. So for this company, the reason why the stock has been down massively just this year alone is because of the tariffs. So they have a lot of their factories outside of the US. So they have around 16 of them in China. They have around 16 of them in Vietnam. And all these different places, they will be subject to tariffs this year. So the US has placed around 20% tariffs on China and 20% tariffs on Vietnam as well. So the cost of goods sold for Deckers will be upwards of 20% this year. But for this company, it is looking cheap at its current price with strong top-line revenue growth and international expansion. Tariff risks were overblown. The cost of goods sold will definitely increase by 20%. But with top line increasing at 15%, you will likely still see earnings growth this year. So if you're looking for an apparel company or shoe company to invest in, I think Deckers is one of the interesting ones out there. But this company is not high quality by any means, so don't expect yourself to hold this one for 10-20 years. Last portion, I'll be covering some questions left in the comment section. So the first one, it says, would you share with us how you estimate or calculate fair value for stocks? I'm interested in MSCI as well as SPGI, but I don't know what is considered fair value for all these companies. So let's take a look at how I value my companies. So for example, this is my DCF calculator for MSCI. So MSCI in the trailing 12 months has around $1.4 billion worth of free cash flow, and they have around 77 million shares outstanding. So assuming a 12% free cash flow growth for this company over the next 10 years, and assuming a 4% terminal growth rate, I think for MSCI, it deserves a higher terminal growth rate as compared to your normal S&P 500 companies, simply because the company is extremely predictable. So at its current price, MSCI's fair value is at around $589 a share. So MSCI is around fair value today. Another company would be S&P Global. So S&P Global has around $5.55 billion of free cash flow in the trailing 12 months, and they have around 307 million shares outstanding. So assuming a 12% free cash flow growth over the first 5 years, because you have the debt wall coming in 2028 as well, and then assuming a 10% free cash flow growth in the last 5 years, the company's fair value is at around $531 a share. So S&P Global today is around fair value as well. And so for these two companies, if you're looking to start a position, I think buying at fair value today is alright. But for me, I have a decent sized position in these two companies already, so I'll be hoping for better prices. The next comment, it says, I would like to ask you if you could include AMD as part of your stock company review. Thanks again. So AMD was once a stock that was seen as a value destroyer, and currently now it is loved by Wall Street. The stock is up around 100% since the lows in April, and it is currently massively outperforming the S&P 500. But in the semiconductor chip segment, I think the best company to buy is simply just to buy Nvidia. So if you were to look at the revenue growth just in the past 1 year alone, Nvidia has grown revenues at around 143%, and AMD has grown revenues at around 21%. So AMD is a lot more focused on your CPU sector, whereas Nvidia is a lot more focused on your GPU sector. Your GPU segment is a lot more lucrative, and that's why Nvidia has seen such explosive growth. And so if you're looking for a chip company to invest in, I think the best company out there is simply just to buy Nvidia. And if you were to look at the valuation as well, Nvidia is currently still trading cheaper than AMD, so there's no reason for you to buy AMD instead of Nvidia. I think Nvidia is the high quality business, so if you're looking for a chip company to buy, simply buying Nvidia would be the play here. I hope you guys have found this one useful and invest safe.